Hi, everybody. Today we're going to talk about inflation. It's been a situation that has been there for a while now, and nobody knows how long it's going to keep going. So we have inflation, the interest rates, so that are rising up almost every second month with the Fed doing their thing. So in this tough economic times, some households probably have some trouble financially to meet their financial obligations. So every time we hear problems, but not too many people are talking about solutions. So we're gonna try to find solutions to this problem that we have right now, inflation, and regarding on how people could create more wealth in these tough economic times. So my name is Richard. My name is Richard Lesperance. I go by the name of mymenrichard. This is Welcome to a Better Lifestyle. This is the podcast Welcome to a Better Lifestyle. And I have three panelists with me that accepted my invitation for this first round table that I'm doing. So if you see that it's not like the other round tables, forgive me. I'm just trying to be creative with the podcast. So I hope you guys enjoy this episode. So I'm gonna have my three panelists introduce themselves. Please tell your first name. Well, tell your full name. Tell your full name and what you do and how long have you been doing it. So we'll start with Pete.
Hey, this is Pete Moore. I started a firm called Integrity Square. We work in what we call the HALO sector, health, active, lifestyle, outdoors. We've done probably a third of the private investments and M&A transactions in the sector over the last 10 years. And we are trying to help solve loneliness, obesity, and diabetes by getting capital to the right entrepreneurs and have them build big companies that are solving these problems. Thanks for having me on.
Okay. And how long have you been doing that?
Just 25 years.
25 years. Well, okay. Stuart.
Yeah, I'm Stuart Kruse. I run Kruse Asset Management. We're a boutique quantitative asset management firm. Basically, we buy stocks, bonds, invest for people using math. We also have a virtual family office, which means large families have their own group of financial professionals running around. So we, on an ad hoc basis, form a team of these financial professionals to help solve problems for, more of the everyday millionaire kind of guy. I've been doing this since the late 90s, so 25 years myself.
Mm-hmm. And Roderick?
Hey there, Roderick Capelo. Thanks for having me on. I wear a couple of hats. I'm a orthopedic surgeon for children. And several years ago, I started investing in real estate, specifically multifamily real estate, but other asset classes as well. And that was going really well. So I realized that my physician colleagues got pitched all kinds of stuff. I didn't know who to trust and what was good and what was not. So I started my firm, Fortis Equity Group, as a way to link folks with investable income with folks doing good, solid deals and real assets.
Okay. So, like I mentioned before in the intro, we have the situation of inflation and interest rates that has been going on for a while now. How do you see this situation moving forward now with the interest rate and inflation in the next few months? And what are the solutions like for the consumer and businesses? So I'll start with Pete.
Thanks. I think my cohorts here might have a better answers than I do, but from a standpoint of the health and fitness arena, I feel like the companies that have raised prices have done it because they can, not necessarily because there's an inflationary component to their business that's dramatically changed. I think the inflation was inevitable. We had supply chain issues, we had COVID related issues. And I feel like the last couple of companies now are probably taking their last gouge at pricing with some of the subscriptions online with the content providers. But I don't see inflation as a long-term issue in my sector. I think it's pretty much under control at this point.
Okay. Stuart?
So I might have a little bit different take. Again, we do everything with math on the side. So, and we try to use history as a guide. So what we saw was $7 trillion go into the marketplace because of COVID. And the definition of inflation are dollars chasing goods and services. So when you throw that much money at a problem, you're probably going to get inflation. That's what we saw globally. So from looking, is it going to be a sustainable problem? What happens is the Federal Reserve had set a Fed funds rate at 0. That's the only really set interest rate in the whole interest rate scheme, is what the Fed funds rate is, and that's the amount that banks lend to each other or the Federal Reserve overnight. So that's the lending rate overnight. And then the banks, let's say the 2-year treasury, which is what you get a rate of return for giving your money to the government for 2 years, that's set by the marketplace. So the Federal Reserve had the Fed funds rate at 0, while the 2-year treasury was very, very low. But when that gap started opening up, that by definition is inflation. It's inflationary pressure that's going to be felt sometime in the future. So if you recall in the very beginning, when inflation started creeping in, Jerome Powell, the Fed chairman, said inflation is transitory. And then that gap opened up even wider. And then he said, maybe it's not transitory. And so he started raising rates. And he kept raising rates and raising rates and raising rates. And he's continued to do so even in the last Fed funds meeting. So he raised rates 525 basis points, so 5.25%. The reason he's raising rates so fast is because that gap is future inflationary pressure that we're going to feel in somewhere 6, 9, 12 months from now. The Federal Reserve has never been able to fight inflation with the 2-year being above the Fed funds rate. Just recently, within the last month, he's gotten the Fed funds rate above the 2-year treasury. So that entire time where the 2-year is above the Fed funds rate is inflationary pressure for the economy in the future. So the reason why the Federal Reserve is keeping it higher for longer and continuing to raise rates right now, even though people are saying no, is he needs to keep that Fed funds rate above the 2-year treasury for as much as it was behind. Okay. So what he's trying to do is not repeat what happened in the 70s and 80s. And if you look at the charts between what happened in the 70s, where you saw an initial spike, and then you saw a come down in inflation, then you saw another spike later, and then you saw a retreat, and then you saw a third spike. So Jerome Powell is trying to not repeat the same mistake as what happened. I think he's going to do a good job, but it's going to be painful for a little bit. And so that's kind of my take on where we are in inflation. So there are going to be fits and starts where you're going to see some resurgence, but I think Powell has enough wherewithal to keep the Fed funds rate higher for longer in order to squash it longer term.
Mm-hmm. And Roderick, what's your take on that? Because in inflation and interest rate, it affects the real estate. So the mortgages, like if you're paying 1,000, maybe you'll be paying 1,200, depending on what you choose. If you choose a variable rate or fixed rate. So what's your take on that, on the situation in the future?
Well, just more globally than that, I kind of agree with what Stuart's saying. You know, if you look at history, I don't think we're out of the cycle, right? In the past, if you look at some of the, where interest rates have gone up, for the date of the peak interest rate, it's an average of about 7 or 10 months until there's a peak of recession. And then even further than that, about double that till the bottom of the stock market after that. So I think that this cycle, I don't believe we're at the end of the cycle as far as the current rates go. Now, whether they're going to go up a little bit more and then come down is anybody's guess. I have to think they're probably going to go up a little bit more before they come down. But I think that they will come down at some point in the next, who knows, 18 to 24 months, hopefully, but we'll see how that goes. As far as how it relates to real estate, specifically, my focus is more on multifamily real estate, but just, in general, I think if you can get a fixed rate, you definitely want to start there, right? We have learned a lot in the multifamily sector as far as investing in real estate in the multifamily sector recently. I mean, no one really saw, a lot of folks had a model where they would, buy a property at a certain price and put some money to fix it up and sell it at a increased value. There were some assumptions there about the cost of what would it take to do that during that life cycle of 2 to 5 years. No one really saw 10 consecutive or more interest rate increases. Also 2 to 3 times increase in insurance costs and property tax increase in many areas. And so I think it's still going to be a challenging market for investing in real estate. But for the multifamily sector, I think if you learn the lessons, like I said, try to remove as many variables as possible. Like if you're able to do a fixed rate, obviously you want to do that. But I think that also have to be aware of the fact that there's going to be some properties on discount. We're sometimes seeing prices that are 25% more of what they were valued at before. So I think you got to stick to fundamentals as far as rent growth, property growth. Population growth, things like that. And, because of the increased costs and interest in the lending and things like that, there's going to be less cash flow than before. But if you can buy a property at a discount and you're really, and the fundamentals of the rent can pay the overhead, the value of that property will be much higher when interest rates decrease and subsequently cap rates decrease over time, which I think will happen. When is anybody's guess, but I think that will definitely happen in the future.
Are you, just a question, are you able to push through rent increases higher than the CPI rate or inflation rate right now?
Say that one more time.
Are you able to push through price increases on your rents right now higher than the rate of inflation, or where are you guys at with that?
Yeah, it really depends on the market, right? Like in Phoenix, we're able to push the rent increases even more than we thought. I mean, everybody's expected to pay more, right? Everything's costing us more. Everyone's expecting to pay more. So people aren't balking too much at rent increases. Now, sometimes there's concessions the first month. You have to, there's a little bit of a decrease in income the first month because you may have to make a rent concession to get it in the property. But we're still, in markets I'm in, which is in the Sun Belt, we're still seeing rent increases that are outpacing inflation.
Gotcha. Thanks.
Pete, so people say sometimes when the economy is like that down, sometimes it's a good time to start a business. Some successful businesses have been built in a downturn. Is it really possible to, what's your take on that, on starting a business in a bad economy?
Yeah, I mean, I wouldn't consider this a bad economy right now. I think it's, pretty normal. If I look back to COVID as one example or story to share with people would be, there was a company called Solid Core, which was a Pilates only bricks and mortar corporate owned store concept. During COVID, they benefited that when people did go back to the fitness inside, Pilates has been a big beneficiary of people feeling comfortable because they're on their own machine. They can wipe down their own machine. They're 6 feet socially distanced from each other. And they use that opportunity to go and raise additional private equity capital during COVID and took advantage of some great long-term lease opportunities in urban markets where, there's blood on the streets, if you will, and landlords were desperate. They have a very small box, so 1,800 to 2,000 square feet. So for them to go in and cherry pick locations that would have been somewhat off limits from a standpoint of what made sense to pay in rent, got them some amazing locations. Post-COVID, they just did a deal at 18 to 20 times EBITDA and benefited from the contrarian view that they had with actually let's build during COVID. And by the time we get to the other side, we're going to have below market rents in areas of urban markets that we want to be in. So that would be the best analogy. And also you can pick up a lot of good talent, during a downturn.
Stuart, a lot of people sometimes they want to invest in the stock market, but everybody remembers 2008, and when the economy tanked with the big recession, and a lot of people lost a lot of value on their portfolio. How could someone take that? How do you take that fear away of that happening to your portfolio? And is there anything like people could have done to protect themselves in 2008 when the economy tanked?
Yeah. So how do you take the fear away? You don't. You don't. You're going to live through stock markets going down 30, 40, 50% at least once every 7 to 10 years. So if you're a long-term investor and you're going to be invested in the market for the next 30 years, you're going to see this several times. So you have a couple of choices. You either reduce it's very difficult to time the market. There is some research that says there are some ways to time the market, but for the average investor, it becomes very challenging. The reason being is the sell is easy. Like we can pretty much, all of us could sell some of our portfolio right now. And I can almost guarantee you at some point, the market will be lower than it is right this very second. So in which case we will have been right. The problem is, when do we buy in? And it's that second decision that's a real challenge. And when the market's dropping, people really have an aversion to buying in at that time. So normally what they wait is for it to feel better than what happened before. And then they wait to a point where it was above where they sold. So they end up having to make two correct decisions as opposed to just wading through the market. That said, your question was, are there things that people can do? Yes, there are. So you want to be risked appropriately. Obviously, when the market's moving up, everybody wants to take on a lot of aggressive risk. But right now, the multiples are extremely high. And so if there's a pullback, it's probably going to hurt people. And if you're over risk, then you may be at a point where you sell and you get out at the bottom. And that's often what happens to clients. So you want to be appropriately risked for your tolerances so that you can ride it out. There are other vehicles that people are not aware of. So most people just think about stocks and bonds. And if I'm aggressive, I'm buying stocks. And if I'm not aggressive, I'm going to buy bonds or some combination between. So there are products called structured notes. It's a $4 trillion asset class that has been around for decades. It is nothing new. It's nothing fangled, like some new invention. Every single large bank that you're aware of, JP Morgan, Goldman Sachs, Citibank, Barclays, they issue structured notes on a monthly basis and have been doing this for decades now. And what these structured notes are a combination between stocks and bonds. And just to give you an example, you can buy a structured note that is principally protected. So, and I'm going to throw in a little side note. I do believe there is a recession coming, and the average decline in a recession is 24%. So if we see a 24, 25% pullback, like you kind of alluded to, if you buy a structured note, you can buy one that has principal protection. So you can't lose any money. But if at the end of this maturity, and like I said, it's like a bond, it might be out 1 year or 3 years or 5 years. At the end of this note, if the stock market is up and not down, if it's up, you get a version of the S&P. So it might be 50% of the upside, 75% of the upside, depends on the note. But you have an ability to protect all of your principal and still participate in the market. That's the most simple version, but there are a lot of these type of structures that are out there that people are just not aware of.
Roderick, people, when it comes to investing, one of the main thing is real estate that most people know. But sometimes the main thing that stops people from moving forward in real estate is the down payment, like the capital to start investing in real estate. What would you say about that?
Well, the way I got involved in investing in real estate passively is through syndications, and I would say that's a great way to go. You know, you're talking about investing in a larger property, not like if you go and invest in a single family home, it's either occupied or it's not, right? So it's kind of binary. But if you invest in a 200 unit complex, at any one point, if someone's not paying the rent, the other 199 are, or, you know, some percentage. And so I think that helps mitigate risk quite a bit. Well, most people can't afford to buy into a 200 unit complex that's worth $10 or $15 million. And so I think syndications are a good way. Some people call it crowdfunding, a good way to get involved, because you can, you know, you're purchasing the asset with various other people. You can mitigate the risk because there's, like I said, it's just not a binary where you're either occupied or not. And oftentimes the barrier of entry can be a lot lower than if it's just, you know, you doing it yourself. That's where I would start.
Okay. Pete, I know you're doing great things in the business world. If someone is starting out in business, wanna go into that direction, how would I say that? They're starting out. They want to have some a side hustle, something like that. What would you say to them? What can they do, like to earn extra income?
Yeah. Hey, before I get to that, I have one question for Rod. If I could just like dissect the syndication, and Richard, I think this might be good for for the audience here. So, Rod, I've looked at a number of these real estate deals where maybe it's a friend or a friend of a friend sends it to me, and they have like, hey, you know, you get your capital back plus 8%, then, you know, you get 80% of the profits until you get X return, and then and then it flips to like the promoter getting 80%. Are there like things that you say like, hey, this promotes bullshit, or like, you know, these guys are taking too much in economics. These guys who are putting a deal together, they're not putting any money in. I feel like it's kind of like a little bit of the Wild West on these syndication deals. Could you tell us what kind of promote you're comfortable with? It's fair, because I've seen things all over the board.
Yeah, good question. And you're right. The compensation structure can be very simple or can be very complex with waterfall of multiple percentages and things like that. I would say in general, just like a lot of investing, the more complicated it is, you know, there's probably for a reason, right? Because a lot of times things are made complicated to confuse people. What I've seen primarily is, you know, depending on the deal, anywhere from a 7 to a 9% preferred return, as you kind of alluded to, and then really the structure you alluded to. The difference in many of the ones that I've helped put together is it doesn't really flip to where the compensation goes more towards the general partnership. It may stay 80-20, you know, for the limited partnership versus the general partnership, or 75-25. But in our deals, it doesn't go to a certain amount and then flips. It just stays that way.
Yeah.
And so,
yeah.
I think
it's just important. Yeah. Good.
Yeah, I think when it flips, yeah, it's okay. When it flips, basically what it's saying is we're going to give you a certain amount, and then your ability to earn a whole lot or get a return much larger than that is really hampered, right? In other words, if the property does really, really, really well, you get a certain amount, but that really above that certain threshold, we're going to reward ourselves. And I think that's just more self-serving than anything. I think, you know, the general partnership gets their amount. I think what I've seen the most fair is very, very simple. You know, 8%. You know, the partnership can decide if it's 70-30, 80-20, and then just, you know, keep that regardless of what there's no threshold. We just keep it the same way. Again, to me, simplicity is the way to go. I think also, you know, having some, you know, some knowledge of, you know, who's doing the deal, whether it's a friend of a friend, as you said, you know, trying to find people that operate with integrity. The thing about this space is, it's hard when you operate with integrity because there's a lot of folks that don't, right? a lot of folks that try to make things confusing for a reason. And so a lot of the questions I answer are along those lines of, well, I heard so and so got screwed and this and that. So it's basically, keep it simple. There's no reason to complicate it.
Yeah, thanks. Appreciate that. So, Rich, to answer your question, on a side hustle, it depends what somebody's objectives are and what they're trying to get to. Obviously, you can hop in an Uber or a Lyft and, make a couple $100 a day. But if you're thinking about more professional related opportunities and how to basically give you more breadth of experiences and assignments, there's I'm not sure what they call it right now. I think it's still called Graphite, but it's basically or spare hire. And if you're a financial analyst or you're a consultant or you're good at your trade, you can put your information up there. And if I need somebody to do a financial model, I need somebody to do due diligence. If Stuart needs somebody to do like some kind of, marking on like trend analysis or any kind of, graphs and charts and things like that, or if Rod's doing like a project and needs to put a PPM together, a private placement memo, this is like a temporary job site where you can go and get qualified people. And I think that's a great way to have a side hustle, make a little bit of money, but also to keep your name out there. And the more clients you interact with, if you do a good job, you're going to create more, potential career opportunities for yourself. So that would be my, I wouldn't go and start a startup if that's not your gig, or do like an e-commerce thing where you basically just buy yourself a manual job on things. I would actually go and try and pivot up into the financial and consulting world and get a couple of gigs. You'll be surprised how fruitful that is.
Stuart, before we press the record button, we were talking about the commodities and options. In the finance world, what are because most people know about stocks and bonds, but what are the other alternatives like people can invest like oil, gas, or anything? Before we're talking about options, what are the different alternatives that people can have?
Yeah. So as I said, most people just think about the stocks and bonds, but really when you're saying I want a diversified portfolio, that means I need asset classes that are not correlated, that do not move together with stocks and bonds. The obvious one is real estate, right? Real estate's number one. You can go out and buy individual properties or a syndicate like Roderick runs, or you can buy a REIT depending on which particular type of real estate you want. You can get involved in commodities. There are commodity funds that you need to be careful because the vast majority of these commodity funds are overarchingly oil. So it's not that you're buying all commodities like gold and sugar and cotton. You're mostly buying energy in those commodity funds. But you would need a strategy. Something that does work really well with commodities in general is a momentum-based strategy. So for the simplest one, like if I were to look at gold, the price of gold today, and what it was 6 months ago, if it's higher today, I buy gold. If it's lower today, I don't buy gold. And that works pretty well with a lot of commodities across the board. Other things that you want to buy in alternatives, the way the math works out, and we are, as I said, a quantitative shop, crypto actually helps reduce risk in even a conservative portfolio. So I'm not talking back up the truck and buy a bunch, but a small percentage of your portfolio, let's say if you had a $100,000 portfolio, $1,000, $2,000 of crypto exposure mathematically tends to make sense for you. That's why the hedge funds buy it, because the math says they should. Other things that work are these structured notes that do not work in lockstep with stocks and or bonds. Options can be used. I wouldn't tag them as a full-on asset class. I would tag them as a tool to protect the assets that you bought. So I can buy puts that would create a floor or insurance, or I could sell calls to create more income, but they should be used sparingly because you can use them extremely risky in a risky way, or you can use them in an extremely conservative way.
Okay. Roderick, what about the alternative in the real estate world? I know you're doing different things. So what are the options for the people?
Well, there's, various asset classes. You can invest in shopping centers, within commercial real estate, certainly shopping office buildings, which is a pretty struggling asset class right now. I don't think I do that. Multifamily is we're learning that's my primary where I've dove deep. There's been some challenges, no question, but we learned some lessons, and there's a lot of properties coming on for discount. So if you're partnered with the right folks that are the performance conservative and really is not counting on market appreciation, but more cash flow from the property pay its own bills, basically, right? That's helpful. Residential assisted living is an asset class that I'm familiar with, that I know several of my colleagues are doing, and they're having good success with that. That's somewhat not tied to the economy per se. Let's see what else.
Roderick, how about those?
Certain,
Can I jump in there? Let me ask you a question. So there were some REITs, private placement REITs that we used to use that went out of favor, but they were, how I would describe them, triple net leases. So on like the corner of Main and Main, you might have like a gas station, a CVS, a bank, and a fast food restaurant. And the way we would often approach this is, do I want a bond from Walgreens that's paying me 2%, or do I want to take rent from Walgreens that's giving me 7%? Right. And it's higher on the credit stack. So the renters get paid first if Walgreens were to go out of business, versus the bondholders get paid second and the equity holders get paid last, right? So how is that triple net lease market doing these days?
Admittedly, as you said about the in your world, that's not my main focus, but my understanding is it's not doing well. Now, the real estate's location, right? So on the corner of Main and whatever, that might be doing okay. But the office building that many companies have used that are off the beaten path and don't need signage on Main Street. COVID taught us, COVID taught us one day, and taught us that we can all do business remotely, right? And so there's a lot of businesses that are still doing that. I would say that asset class specifically is not doing well. I personally am not investing. I invested in that a while back, maybe 3 or 4 years ago, and that's not something that I'm going to be focused on. My understanding from my colleagues that are primarily involved in that is that's probably the asset class that's doing the worst, but honestly, of the
triple net leases are.
My understanding, yeah. Mm-hmm. Yeah, I mean, again, it depends on where it is, right? It depends on where you are. If you're in a prime location, sure, those are still doing well. But I mean, my building here is a triple net lease, and it's a little off the beaten path, and it's probably about 60% occupied.
Okay,
right now. It's a medical office building, so that's maybe that has something to do with it, but
interesting.
Again, primary location.
We had during COVID, Stuart, we had a number of REITs that we were working with that had big health club exposure to Lifetime, LA Fitness, and movie theaters.
Yeah.
So it was definitely there was a tug of war on what was abated, and most of the companies I would say have gotten through that, but there's some wild things that happened. Like LA Fitness ended up suing the REITs before they sent them a default notice, basically saying that 1,200 of our employees got COVID. Therefore, there was damage to the property, and therefore you owe me back rent instead of me actually owing you rent.
Wow.
Because my I don't have quiet enjoyment, which I thought was a pretty radical 800-pound gorilla approach. And then Equinox, I know, basically said, hey, look, we're not paying rent. Try to kick us out and find somebody else who can, get that kind of dollars out of members that is actually going to replace my spot. So kind of just sit tight. And I still think they have a lot of, I don't know for a fact, but I think there's a fair amount of liability that they still owe that they haven't negotiated out of COVID from some of their abatements from the landlord. So I think sometimes the large numbers, you think, oh, it's awesome. I got 150 LA Fitness leases in a REIT. And they pay every month because their members pay every month. And then you realize they might be too big as part of our portfolio, where they start dictating terms. So that's what I've seen.
And Stuart, I'm sorry to be Stuart, to be clear. So if it's like you said, Walgreens has occupied that property, that's one thing. If it's a stable tenant with a long-term contract, that's one thing. I guess I was thinking more along the lines of a office building with a bunch of different tenants, smaller companies, things like that, or strip mall, something like that. that a lot of the smaller companies are struggling. So if it's a flagship company that's got a long-term lease, certainly that would be that's a long-term play, more conservative play that could be successful. But the ones that I'm involved in are more like strip malls, things like that, and that now getting those involved in those now, that can be a little bit risky because those are smaller companies, a lot more regional companies, things like that.
Yeah, clearly the strip malls have been struggling. Any of the mall properties have been struggling for sure. But like banks have done well, gas stations, the pharmacies, the fast foods. I know fast food had some issues during COVID, but even like McDonald's was allowed to be open at the time. They're doing fine, hitting all-time high earnings. So
automobile industry as well could be.
The car washes too now. Express car washes seem to be, and Planet Fitness. Those are some good places though in property.
So Pete, when someone's starting a business from scratch and they wanna build it and scale it up, how long would you say it takes for someone who's starting a business from scratch, for them to be profitable?
No, well, it depends on who your investors are and how much money they're willing to give you to get to that rate. Look, the short answer is if you're not profitable within 24 to 36 months, you probably haven't figured out what the special sauce or what's unique about your business. Obviously, if you're a venture-backed business and the goal is to generate revenue and not generate profits in order to get market share and then, Trojan horse the whole company against the membership base or whoever, you're extracting value from, it's a complete other story. I mean, Peloton hasn't made $1, maybe during COVID, during a shipment, they did. But, there's a lot of companies out there where people should shut them down. And it's okay to fail. I went to business school. They didn't teach that class. I wish they did. Probably would have shut down a couple of businesses way earlier than keeping them alive and funding them. But look, the one thing I do say is if you're running a franchise or you're running a franchisor, which is a lot of multi-unit work that we do, like you got to live in the location that you build, figure out the special sauce of it, and then that becomes a model that then becomes franchisable. Just because you built a brand, you've got traffic, doesn't mean you should let somebody operate your playbook when you don't even have one. So that's one of the issues I have with franchising in general. Got to have over $60,000 a month in revenue, just $2,000 a day in order to be a viable business that you want to let somebody use and feel good about handing it off to them. But I would say after 24 months, if you're still losing money, like you got to reset what you're doing or pivot or shut it down and tell everyone you gave it your best shot. But there's too many businesses out there that should not be in business anymore. Just leave it at
that. Stuart, if people want, when they invest in the stock market, they're thinking of cashing in when it's time to cash in on the portfolio, like receiving dividends and whatever. What would be like the strategy, or like, because you probably have when people retire, they have different sources of income, so they have their portfolio. Maybe the portfolio could generate income for them at retirement, a certain percentage. What's the strategy for that, for them to have a good percentage, like maybe 20% of their income is coming from their portfolio? How would they structure that?
Well, like all answers, it depends, right? And a lot of my clients, 100% of their income comes from their portfolio. So the rule of thumb is that you can take out about 4% of your portfolio in any annual period of time and still have a sustainable portfolio. The idea being that if you're making around 7% and inflation is around 3%, you can take that. These are just real rough numbers, but you can take that 4% out and still have a sustainable portfolio that still maintains your purchasing power over time. What I don't recommend is trying to completely match the income generation of your portfolio with your income needs. And what I mean by that is if you need $100,000 to live, your portfolio does not necessarily need to generate $100,000 worth of dividends and interest as a spill off in order to sustain your living environment. What happens then is you just completely focus on a couple of different asset classes, like just dividend producing stocks and bonds. And if you do that, you end up ignoring all growth stocks and a variety of other asset classes. And it ends up being a less efficient portfolio. So what you really need to be doing is looking at a whole, and a lot of clients don't even have an income in retirement. Sometimes they will, sometimes they'll have an annuity or a side gig or a pension or something along those lines. But a lot of clients, they've saved up in their 401k and all they have is the 401k to sustain them going forward. And so then the question comes of, how do I take the money out of my stocks, of my IRA and my IRA rollover, or my Roth, which is tax deferred? And then that requires usually some modeling, because the money out of the Roth is not taxed. The money out of your investment account is also not taxed, except for the gains is ongoing. The money out of your IRA is taxed at your ordinary income level. So you might want to just take money out of your investment account in your Roth first, but then you're faced with required minimum distribution at some point where you have to take money out of your IRA. So sometimes it makes sense to take that earlier. So really you need a tax strategist or a specialist to kind of model that out for you. That's what financial planners actually do.
Roderick, in this time, like I was saying, inflation and the interest rate, the cash flows of the investors in the real estate could be affected if the tenants can't pay their mortgage and all that. Well, not the mortgage, I mean the rent. What are the backup plans that people have, and what's your take on that?
Backup plans?
Yeah, something like a backup plan, like if people can't pay the rents or whatever, like an investor has different investment in the real estate. What happens? Well, not what happens, but what could they do?
Well, I'm not sure.
Bankruptcy or something?
Yeah, I'm going bankruptcy.
Yeah, bankruptcy is an option.
I mean, I would say first off, I like to focus more on Class B or C properties, which are not the shiny new properties, mostly Class B. Because if someone loses their job or their money gets tight, they may not be able to afford a home, so they have to go to an apartment, or they may not be able to afford the downtown high-rise condo, the bright shiny condo. So, but people have to live somewhere, right? So even if it's not as nice a place as they want, they have to live there. So I mean, I think so in that asset class, we've found that it's less volatile than others. But as far as a backup plan, I'm still not sure I understand your question as far as investors' backup plan. I mean, if enough tenants can't pay the rent, then you have to go back to your lender and see if they can restructure your loan. That's certainly one option. But if no one's paying the rent, that's a problem. But I would say that the economy is probably falling apart at that point. If enough people are not able to pay the rent, I'll probably just come stay with you if that's okay.
Yeah.
Do you guys think people should be more educated financially, have more financial literacy, to know and about the economics and all that? So when these things happen, people could make the right decision. What do you think about that, Pete?
Yeah, I mean, look, I don't think people get practical training either, whether it's in elementary school, high school. They should teach people how to do their tax returns, in 10th grade. That would probably be a good use of 10 classes in high school. People should learn how to, what investing in all these different asset classes means without having to take like a finance class. Like that should just be like, diversifying your net worth, or what's pre-tax and what's post-tax. How do I spend money on this type of budget? I feel like there's like very basic math and basic, guidance that My nephew, my niece don't talk about it. They're on my Roblox or Call of Duty or something. So they're not doing these things. But yeah, Stuart, I'd probably defer to you on what you wish your clients had as like a foundation. Because I find sometimes it's just, they don't know what EBITDA is, and they're not really thinking about their investments except just what's in their bank account. As an entrepreneur, it's going to help a lot of people.
Stuart, what's it?
Yeah, I think that's of course they need to have more financial literacy. And I'm actually working on an online course right now because I have clients that get divorced, husband and wife get divorced, and invariably one person has handled the money and one person hasn't. So if there's any kind of significant split of assets, now you have one person that is in charge of this pile of money that they need to depend on for the rest of their life, and they have zero understanding of what to do with this. And it's actually pretty, I'll go with the word sad in a way that, they just don't know how to, they don't know how to even evaluate somebody. And for example, and I'm not saying that there's anything bad for them. For example, I'm an engineer by undergrad, but if I go to an auto mechanic, I couldn't tell you like which auto mechanic is better than the other auto mechanic. Like I just don't have the skill set. I just have a real, you just kind of go by feel. And similarly, they will go by feel with their financial advisor, and they don't know the difference between an advisor, a financial planner, or a broker. So yes, they need all of that. They need all of that. And the more education, the better. And the better off that they are. And in fact, for my clients, the more educated they are, the better I think I can work with them, and the more that they'll be excited about what I'm doing for them.
Roderick, what's your take on that?
That's great, sir. By the way, I couldn't agree more. I mean, some folks are, like you said, one of them's in the know and one of them's completely not, and they're just left holding the bag there. So I'm still practicing as a pediatric orthopedic surgeon, and I kind of liken it to that. Do I want my patients to come in with, are they going to come in knowing exactly what I'm talking about? No, but it is nice when they have some basic knowledge of what we're talking. We can have a more concrete conversation, a conversation where I can talk to them in a real fashion, not just sort of dumb it down or make it too basic, so to speak. I have some patients that come in and they go, just do whatever you need to do. Well, that makes me uncomfortable a little bit because they're not really understanding. So, how does that relate to what we're talking about? Same thing. I think, some knowledge is very helpful. Now, is it realistic for everyone to have all the knowledge they need to? No, that's why you have these gentlemen on the panel here. So you either have the knowledge, or at least know someone who has the knowledge and the trust in them. But always more information is better. My patients say, "Oh, you don't really jump on the internet." I say, "Jump on the internet. That's fine. I feel comfortable when I tell you. I can tell you what's correct and what's not." Well, same thing with investing. Well, my cousin's broke uncle says blah 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 blah. Well, that's probably not the best place to get your information. But people come with preconceived notions and things like that. But it's just in general, I think knowledge is power. But you can't also get to the point where it's paralysis by analysis, right? Where you just try to get more and more and more information and never really pull the trigger. I was in that boat when I first started passive investing, and basically I knew someone that knew more about that, had more experience than I did, and I trusted them, so I was able to get involved. And so you have one or the other. Some knowledge is great. You have to know it all, or trust someone who does.
Before, Stuart, you were talking about a recession is coming. A lot of people said from before that we are in a recession, or it's coming. So nobody really knows. How's the situation, the market right now? Like the housing, the job situation. Are there any are people struggling really financially? Are there bankruptcy defaults? What's the situation right now?
That's a great question. So the Federal Reserve, let's take a step back. So in Q1, just about every economist on the planet was calling for a recession because there's a yield curve inversion. What that means is the 2-year Treasury is paying more than the 10-year Treasury. Normally, when you give the money to the government for 10 years, you expect a higher rate of return than when you give it to them for 2 years. What's happening now is you get a higher rate of return for the 2-year versus the 10. So that means it's inverted. What that implies is that the 2-year is going to fall considerably at some point. And generally when that happens, there's a recession. So now what happened was almost all the economists were suggesting that there was going to be a recession. And now a lot of them have backtracked because the economy, to answer your question, is looking really, really strong. Unemployment is super low. Housing market seems to be relatively strong. There's not really a lot of data that's suggesting that there's bad economic conditions right now. The stock market is super strong. AI is fueling a lot of investments in technology, and that's getting to be, a little bit of a fever. But there are some indicators that are suggesting that maybe something's coming. So we had a excessive amount of savings rate post-COVID, and that has almost completely worked its way off right now. We have delinquencies of consumer debt are trending just above the long-term 10-year average right now. So the delinquencies are ticking up. And you have to remember that now that interest rates are higher and we had inflation, they're higher than they were before. Every day, let's say, there's a new loan that resets from a new mortgage that resets from a 3% to a 7%. So every day the economy gets a little bit more challenging. It's not that like, hey, on September 3rd, there's a doomsday event that's going to happen. No, every single day, another loan resets that's a little bit more expensive. So when I did some math on the time that we have from an inverted yield curve to the time that we have a recession, on average, well, the range is between 300 and 600 days. So on average, it's about a year and a half. So from the time our yield curve is inverted right now to a year and a half, that is November of this year. And a lot of these things go out actually 600 days, which takes us into Q1 or Q2 of next year. Having an inverted yield curve does not necessarily mean we're going to have a recession, but we have had a recession in every inverted yield curve since 1975. And every recession we've ever had since 1975 has been preceded by either an inverted yield curve and or a tightening Fed, which we have, and or higher energy costs, which we have. So I'm not saying it's guaranteed, but the math and the numbers suggest that we're going to have one. And the final kind of straw on this is if people are projecting for the 2-year treasury to fall and for interest rates to decline, which they are, and the market's suggesting the treasury rates will start to fall come Q1, every time that has happened, it's because we've gone into a recession. The Federal Reserve and the 2-year doesn't fall because the economy is great. That's just not how it works. If the economy is great, they raise rates to stop it from overheating. They drop rates because the economy is getting weaker and trying to stave off that recession. So I don't see how we're going to avoid it. I just don't see how we can avoid it is really the thing. So I'm projecting fourth quarter of this year or Q1 of next year. Right now it looks strong.
This is going to be a special question. Maybe Stuart, you could answer that. When is the last time we've seen deflation? And do you think that's does it happen every 100 years or what? Do you think that's going to happen in the future? When is the last time we had?
We saw deflation in 2007, 2008, right? So that was the big concern, and that's why they were raising interest rates. So when the mortgage crisis happened, the velocity of banks stopped lending to each other overnight. They wouldn't even lend to each other. Okay. And that's why the Federal Reserve had to start passing out money in TARP funds. They were giving money away so that banks had to take the money so they didn't have to borrow. I can get into this whole thing, but there was deflation there. And so the Federal Reserve dropped interest rates to zero, trying to start inflation, but they couldn't do it. Now, Bernanke was the federal chairman at the time, and he was a student of the deflationary period of the Great Depression. So he was really combating that. And that's when he started quantitative easing and started a new tool that we had never used before. And we're still on this quantitative easing right now, even though we're trying to unwind it, some 15 years later. So this has been an ongoing thing in the economy. And we're just now moving away. Honestly, we're moving away from the deflationary scare because we quite honestly, as an economic engine, don't know how to get out of deflation. That's the fear. We feel comfortable that we can combat inflation. We just raise interest rates. But deflation, dropping interest rates to the floor, and in some cases overseas, they made them negative, doesn't always work. And it didn't always work. For example, Japan had been in a deflationary spiral for 30 years. So we are more comfortable in that inflationary environment. So we saw it, but we fought it pretty hard. What'll happen? I mean, in order for that to happen again, there have to be a banking crisis probably, and banks would have to stop lending to each other again.
Last question, guys. We have 5 minutes left.
I'm sorry. Can I just add just a little bit to what Stuart said? Excuse me. I'm so sorry.
Yeah, no problem.
I agree with what he said. I was looking at some different indicators. You know, if you go back to the great financial crisis of 2008, the Fed started raising rates as far back as like 2004. And if you look at, when the peak occurred sometime 2006, and then a recession 18 months later, if you go back and look at some of the data, as far as the data peak interest rate, and then the lag between that and recession, go back to the 1970s, it's about 10 months in several different instances. And so, as he's saying, what is the peak interest rate? Are we there yet? We may or may not be. But I think that I think a recession is coming, but it's just more delayed than we think. And it's sort of this this golden period with everything seems we think the economy is doing well. I think it's just this cycle takes longer to play out than a lot of people think, and it's going to get worse before it gets better for sure, in my opinion.
I agree.
Last words, guys, on this topic that we talked about. Is there any hope or positivity that you guys could bring to the people with the situation in regards to the economy, inflation, and everything that's happening? Pete, what's your last words on that?
Yeah, I mean, I was on a podcast the other day, and the guy had a sign behind him that says, "Your life is 100% your responsibility." And I kind of thought about that. And it's like, hey, look, you got to make the right decisions. You got to sleep in the bed that you make. As Stuart was talking about, how you can diversify your wealth and different options. The one thing I would just stress to people, and Stuart, maybe, and Rod, you guys can comment on this after, is if you invest in a company and it's a startup company, you can't call that money and get it in 2 days. You can call your broker and sell Apple stock and get that money out. So the liquidity preference and the liquidity cost of actually being able to move money. If you're a young entrepreneur, if you dump all your money into your company, you can't borrow against that at the bank and say, hey, I own 100% of this software company. They're going to be, I don't give a shit. If they own 100% of this building, they care and they'll loan you money against it. So, I ran into some situations where I just kept doubling down on early stage investments as like a deal junkie. And you realize that money is illiquid. So I would just tell your people in the audience here is don't go and buy 5 real estate deals or 5 early stage investments where people say, hey, 25K into these 5 things that one of your fraternity brothers or sisters or something is investing in, because you're probably not going to get it back. And it's just an asset on your financial statement that has no real value outside of your own, cocktail party talk. So I'll pass the torch on that.
Stuart?
Yeah, I agree. And just about everything we do is fairly liquid, but that's a really important point. Is there hope? Yeah, there's always hope, of course. And we're going to go through these ups and downs. And the U.S. economy is an amazing tool, and it's resilient. And, but there's going to be struggles. And every time there's a struggle, it opens up a new opportunity somewhere to find. So what I would say is my last word is don't chase these returns that you're seeing, like from companies like NVIDIA that's trading at 44 times sales. Most companies will trade at 2 times sales, and it's trading at 44 times sales, which means a manufacturing company, a chip company, has to grow its top line revenue and produce 20 times more what it's producing today in a supply chain constricted world. Don't chase that. Be risk appropriate for what allows you to sleep at night.
Roderick?
Well, one of the things things I love about real estate is, I mean, it's a necessity of your life. Everybody has to go to a place at the end of the day and go to sleep. It's also tangible. You can go and kick the side of it if you want. There's no question that there's some challenges, but you know, if you have cash on hand, there's going to be many multifamily assets purchasable at 25% discount. So if you talk about buying things cheap, right? We all know that you make money in investing on at least in real estate on the purchase, not the sale, right? And so if you buy at the right price, then you're more likely to make money. This is all cyclical, as Stuart said. It's all cyclical. So you buy now, stock buy low, sell high. Well, it's low now. Might be a good time to buy if the market fundamentals are correct. Obviously, there's some things that have to happen, but if the market fundamentals are correct and it's a good market with some job growth and things like that, it's not oversaturated by builders and things like that. This is a good opportunity actually for real estate investors in real estate in certain asset classes. But again, you have to understand your risk tolerance and invest accordingly.
Thank you guys for accepting my invitation for this first round table. I hope everybody enjoyed this episode and learned a lot. So thank you guys once again, Pete, Stuart, and Roderick for doing this with me. It means a lot. So on that note, thank you everybody for listening to this podcast. Welcome to A Better Lifestyle. My name is Richard.lesperance, and I go by the name of mymenrichard. Wherever you're listening the podcast or where you're watching, make sure to follow and subscribe. And if you could also give a review on Apple Podcasts or Spotify, would mean a lot. So it helps people find the podcast. So on that note, once again, thank you everybody for taking the time to listen to this podcast. Thank you to my guests, my panelists, and we'll see you on the next episode, everybody. Bye.
Thanks.
Thanks, very much.
Good to meet you guys. Thanks, Richard.
Likewise.
No problem, guys.
All right.